Hi and hello everyone to the webinar of FM Day 2. This is your instructor Rizwan Maniya. I hope you are doing well. I hope you all are connected and ready for Day 2. Kindly confirm everyone, is my voice clear and audible to all of you or not? Great, thank you very much. So guys, here we are with day 2 of FM. I hope day 1 went well for all of you. Let's begin with day 2 campaign. This is about myself. I've already mentioned my teaching experience, more than 18 years. 63 plus students were my position, were students who took the position, were my students who became the position holders. And I've conducted lots of webinars. This is my 21st webinar for FM from VIFHE's platform. We always conduct these free sessions for all the papers, and students do benefit and they pass as well. So let's see this time how many will benefit from these free webinars. How to remain connected with me. So this is my number. You can contact me, being the principal here. I'll be happy to help resolve your problems and issues. Then for any conversation you need to do with me during the webinar, this is a chat box. You can message here. I will be happy to answer. Plus, do join FM global groups where I'll be sharing all the materials after the webinar. All the key things will be shared there. All the resources, help, guidance, revision, all will be shared there. So make sure you are part of these free global FM WhatsApp groups. I'll ask my team to share the link with you people. The team, please kindly share the link of FM General WhatsApp group in the chat box, so that who are not part of it should join this global WhatsApp FM group. So the team will definitely share the link in the chat box in a while. You need to join this group and be part of this group. Make sure that you don't miss out, because this group is key. The team is just sharing now. They have shared it. Please kindly check. Just click it. Get into the global WhatsApp FM group. All right. Thank you very much. Those who will watch this in form of recordings at a later stage, make sure that you can contact the admission department, and they will be happy to share the group link with you people as well if you want to join group. And all those students who will watch this in form of recordings, you can contact me anytime for any help, support, guidance. I'll be happy to help you. The revision camp has already started. I've mentioned in the last session as well. Those who are interested in the revision camp can join the self-study students. I repeat, the self-study students. This is a good opportunity for you to cash and be part of this. These sessions, these revision camp will include top 25 to 30 important areas, and their practice questions will be available to you, followed by 2 mocks. One mock will be a live mock with script marking for the mock will be done. We'll give you the feedback, and I'll conduct a live debrief for that mock as well. The other will be a complimentary mock that you will solve with a complimentary debrief in the recorded form. Then grand revision will be conducted. This will be a good revision, knowledge-based revision of all important areas. So those who will be part of the revision camp will also benefit from it. Interested students should contact the admission department, admission team at this number, and the team will be happy to provide you the details and get into this course and see and improve your chance of passing in March 26 attempt. What is the plan? So we have made a plan for the students who will be part of this last month revision camp. So they will be given with the recorded content access that they have to try to complete till 20th of February, because 21st we have a live mock. This will include your very important e-notes, summary notes, theory drafting documents that will help you to draft the theory, plus $1 million cheat sheets as well. Those will be very useful for exam success. On top of it, the free sessions you are already taking. This is the day 2 of the free session. Then you have to watch the December webinars from tomorrow for next 2 days. And then on 18th, we'll have a live revision. 21st, we'll have a live mock. 25th, we'll have a detailed debrief of that mock 1. The result will be announced as well. And then you will be attempting the complimentary mock. So this is the plan. This is a very good option for you people. We are offering it at a huge price reduction, fee reduction. Make sure you are part of this and take maximum benefit. Interested students, again, this is the admission number. At the end, you can contact them for whatever information you need regarding the revision camp. Today's topic includes working capital risk management, one of the key areas of exam. This is very much hot area for CRQs, whereas this is for MTQ. We will be targeting this area today. Let's start with working capital first. Working capital is basically a very simple formula of working capital, and that is current asset minus current liabilities is equals to working capital. A business that wants to survive in long run needs to have good working capital, needs to have good liquidity, because even if you're profitable, you don't have cash, for the survival purpose, you might not be able to survive even you are profitable. So the business survival is very much dependent on working capital. It requires a good working capital management as well, because if it is working capital, you have to manage it properly. So let's look into the summary. Working capital management includes multiple areas, but first of all, before I go towards the management of working capital, there are certain objectives that we have to ensure. The objectives of managing working capital includes profitability versus liquidity. So you need to strike a balance between liquidity and profitability. If you want to manage working capital, it is important to strike a balance between these two. I cannot give preference to profitability over liquidity. I cannot even give preference to liquidity over profitability. It is very important to ensure a balance between these two. All right. So a good business and a good working capital management will ensure a balance between these two, liquidity and profitability. Now then, if we want to manage working capital, how should we manage working capital? So we need to manage the individual components that are part of working capital, and also through the ratios. I'll first start with the ratios here. There are two groups of ratios that one can calculate. Those ratios includes liquidity group and operating cycle ratios. Liquidity ratios includes current ratio. You should know what current ratio is, quick ratio, and working capital turnover ratio. Okay. Now, these are the ratios that are liquidity indicators, how good the liquidity of a business is. Like, for example, if a business has a current ratio of 2:1, so it's an ideal ratio where you have $2 current asset to meet $1 liability. The other group includes operating cycle ratios, where you look at the raw material days, where you consider WIP days, where you consider finished goods days, you consider receivable days, you consider payable days, and all these then results in a working capital. Sorry, all this results in a cash operating cycle for you. Okay, so operating cycle ratios indicates the number of days it will take the raw material to be in raw material form, WIP to be in WIP, finished goods to be in finished goods before you sell it. Receivable days indicates how many days your customers will take to pay you, and payables will indicate how much days you will take to pay your suppliers. So this results in a formula for us, like raw material plus WIP plus finished goods plus receivables less payable results in a cash operating cycle. Now, what is cash operating cycle? Cash operating cycle indicates the number of days your cash is stuck into this entire manufacturing cycle plus the sales that you have made. The more the days of COC, guys, the more will be the finance cost, the more support you will need to fund your operations. Uh, then from these ratios also we do find out two problems if business is facing. The first problem is known as problem of over trading. What is over trading? Over trading means that business is trying to expand its sales without a proper support of working capital, which means you are trying to increase the sales, but you are not investing in the working capital to support the sales. That is over trading. And the other problem is over capitalization, a situation in which a business is investing too much in its current assets, which means you are using a lot of investment, lot of cash into inventory, receivables, and this is known as over capitalization. Okay, so the basic difference, if you want to know, between over trading and over capitalization is what? In over trading, the businessman is not using his own extra funds to support the business operations. In fact, is using lot of short term liability to fund the operations. So this means he is using external finance a lot, whereas in over capitalization, the businessman is using his own funds a lot and may have made investment in too much of inventories and receivables. All right then. When it comes to management of the individual components, so obviously it's a very simple thing. You guys know it's basically current liabilities and current asset is equals to working capital, as I mentioned earlier. So when I say current asset, it includes a lot of things like inventory is part of current asset. So you need to manage inventories properly. It includes cash. You need to manage cash, plus it includes receivables, so you need to manage the receivables as well. Okay, so basically individual component management means managing inventory, managing receivables, managing cash. All these are very crucial from exam perspective. When it comes to liability, so it includes management of current liabilities like your creditors, for example, plus overdraft is what you have to manage. So this includes all the components that are part of current liability. So individual component management is very clear. Good management of inventory means using EOQ, you can manage it properly. Economic order quantity is a concept that will ensure that your inventory cost is lowest. Then similarly to manage cash as well. So there are different models in cash management that you can use, like if you know, one is the Bimels model, very much similar to EOQ. Second is Miller Orr model, a model in which you do consider the fluctuation of the cash requirement. So Bimel model basically indicates that how much cash is needed to be transferred from investments to meet the current daily demands. This will result in, again, it's very similar to EOQ, so it will result in a balanced cost and it will result in a lowest cost of holding and the transaction cost. Okay, the 2S rule applies here, whether it is EOQ or Bimels model. 2S rule means your holding and ordering cost are same and their sum is lowest. Okay, but the problem of BIML is that it does not considers fluctuation in cash requirement. It says the cash requirement is constant, which is not the case. In practical world, there will be cash demand fluctuations. So Miller deals with it in a better way by using certain limits like upper limit, lower limit, return point. So when you reach upper limit, you need to make investments to come back to the return point. When you reach lower limit, you have to sell the investments to come back to the return point. So the difference of upper and lower limit is known as spread. Okay. Then comes receivables, and when it comes to receivables, so a proper management of receivables is very, very important. There are multiple ways through which we can manage receivables, because if we are not getting receivables on time, so it results in problem for the business. So to ensure that you collect your overdues within time frame, there is a follow-up system that one can use, like you can send people, your customers, reminders. You can call them, you go to their you workplaces to visit them and ask them, come on, when will you give us the amount? Then you may in certain cases restrict their supplies, which is not a very good thing. But again, if you they are not giving you the amount, so maybe you can use external debt agencies like factoring is one of the external debt agencies. We'll discuss about that later. So factoring is external debt agencies, and you may go for legal cases. But to make this entire follow-up system easy for you, you can do one thing. You can offer them early settlement discount. So when it comes to early settlement discount, it is a good option if you offer them early settlement discount. So maybe because of the discount advantage, to take discount benefit, they may pay you earlier. They may not create problems for you. So you can give them a cash discount. This is not a trade discount. It's a cash discount where you ask them, okay, you pay in 30 days. If you pay me within 10 days, I'll give you 1% discount. As you pay me in 30 days, if you pay in within 20 days, I'll give you 2% discount, 1% discount. So that is a cash discount that you give your customers in order to ensure that they pay you on time. But the question is, should we offer them a cash discount or not? So for that, it is important to perform a good simple cost versus benefit analysis, where you will compare the benefits with the cost to see whether it is worthwhile for you or not. So what we do in terms of benefit, you see that if you offer discounts, so what benefit will you get? The major benefits like your bad debts might go down, because now people, to get the discount, they will pay you. So bad debt will go down, may go down. Plus it saves in your administration cost, because not very much follow-up will be required, because people will pay you on time. Lastly, yes, if they pay you on time, so your receivables will go down. Your receivables will go down. And once your receivable goes down, which means less cash will be stuck into the receivable, resulting in lower need of finance cost. Now your finance cost requirement will also go down, because you're getting cash much earlier. So these benefits will be compared with the cost. And the major thing that you have to consider is the cost of discount that you get. So all these benefits basically will be compared with the cost you incur, because this cost of discount is something that is relevant for you. It's an additional cost that you are bearing in order to ensure that they pay on time. So the benefits of giving the discount will be compared with the cost of the discount, and whatever figure is bigger, we'll go with that one. Like if the benefits are more than the discount cost, we will give them discount. If benefits are less than the discount, then obviously we have no choice, and we have to we don't have to offer them discount, because the cost of discount is more than the benefits that you are getting. So to make this process easier, you can give them early settlement discount. But if nothing works, you can use external debt agencies like factoring as well. So what is a factor company? Factor is basically a company that will take over your sales administration and collection process. Okay, they will deal with your sales and customer recovery process. They will be in front. They will do everything themselves. They will take over your sales and receivables department. Plus they will give their best to recover the amounts from the customers. But if you have taken a recourse service from them, in that case, whatever bad debt you will face from the customer will be your responsibility as a company. But if you opted for a non-recourse factoring services, in that case, bad debt will be the responsibility of the factor. Just in case, if the company is not able to recover it, if the customer doesn't pays, so factor will take the responsibility of this, and this is in case of non-recourse factoring. On top of it, it's not just that you take service of administration and debt collection, which includes recourse and non-recourse. You also take a service where you ask them that they should finance you. Okay, so you also take financing service with them as well. Other than this administration and debt collection, this financing service is a one in which you will you will take around 80, 75 to 80% advance payment from the factor, and because they are advancing you, so for this they will charge you extra interest cost, additional extra interest cost they will charge you. So basically it's administration and debt collection plus factor financing. So again, whether to opt for it or not, whether to use this service or not, we will be weighing cost versus the benefit. Again, we'll be comparing benefit with the cost. So if I go with the factor service, what benefit will I get? Again, there might be a genuine decrease in the bad debt, or the factor may take up the bad debt responsibility, so that is a saving for me. Less hassle to be done, so admin cost will go down. Plus, because the factor is a specialist company, they can manage receivables in a better way. They will have a good process of recoverability. So they might be able to recover quickly from the customers. Hence, your days might go down. The receivable days might go down. And once the receivable days might go down, so less finance will be required to support the operation, because your cash will now not be stuck in the receivables. So this will result in decrease in finance costs as well. This versus the cost side, the factor fee. Obviously, factor will charge a fee. Plus, remember, if it is a recourse factoring, the fee will be a bit less, because bad debt is not the responsibility of the factor. But if it is a non-recourse factoring, the fee will be charged more by the factor, because of the additional responsibility they are taking for bad debt. So I hope this is clear to all of you guys. Plus, if you are taking any finance from the factor, so this finance will result in additional interest cost that you will pay. You are already taking finance from overdraft, but maybe a condition of the factoring would be that you also have to take their financing services. So if you take finances from them, they will charge you interest cost. But what is relevant for us is the additional interest cost on factor finance. The reason why additional is relevant, because currently you are already giving interest on OD. The thing that you have to see is, I go with factor. The thing that you have to see, if I go with factor, because of the factor, what additional amount will I bear because of factoring compared to the normal overdraft. So whatever is the additional amount, you will be paying that amount in form of additional interest cost of factor finance. We'll compare this with the benefit, and if benefits are more, we'll go with it. Otherwise, we will not opt for factoring services. So I hope this is clear to all of you. It's now time to start with our first CRQ for today, guys. This CRQ is a very important one as a latest exam question. I already mentioned that we are doing the latest exam question. So just keep hold of things. Just try to understand what I'm doing here, and you will see good results. So remember certain tips for Section C and different tips today compared to what I gave last time. Complete this in 36 minutes. Yes, that's perfectly fine. Plus, make sure you perform calculations in a structured and a clearly set out manner. Because see, examiner will give you marks for the calculation. So if the calculations are not clear to the point, if you are using calculators, which you should not, you have to write everything in on the spreadsheet. I don't want you to write the basic formulas, but perform calculations, numbers in the spreadsheet to get the marks. Plus, in terms of your English, it should be a simple English with use of headings and easily set out uh, uh, format, so that one can read it easily. So these are few tips that we are giving you for Section C CRQ. Just keep this in your mind. I did mention that whenever you are drafting a theoretical answer, look at the verbs, look at the objects, look at the marks, and think of any headings if you can plan for that CRQ. Okay. All right, then, guys, done with this one. It's now time to start with the first question. Here we are at the question. What usual practice we follow whenever we solve a CRQ is that we will highlight verbs and objects. So first, evaluate is the verb. What to evaluate? Financial effect of early settlement discount is the object. So we have to evaluate how useful the how useful early settlement discount will be from financial perspective. Then evaluate another verb, the financial effect of factors offer. Okay, so you have to then consider the factors offer, and then advise is the verb. Which proposal is financially preferable? For just 1 mark. Marks suggest that you don't have to write too much here. Okay, you don't have to write too much here. So done with this 10-mark requirement. Then discuss is the verb. Again, what? 3 benefits, just 3 benefits of Treasury Department. In fact, centralized Treasury Department. Okay, so 3 benefit means 2 marks each. Then discuss another verb. What? 2 cash management models. 2 cash management models used in financial management for 4 marks. Again, 2 marks each. Right. Done. So we have a 10-mark theory and 10 marks for the calculations. Let's start with the calculations first. Constant company is a company that operates internationally and has 2 subsidiaries companies located in foreign countries. Okay, done. They operate internationally and they have 2 subsidiaries in foreign countries. The business operations are undertaken in several different currencies. The parent company and the 2 subsidiary manage their own financial affairs. All right. The company has an annual. Now, all the numbers, percentages, make sure you highlight, please. All the numbers, percentages, make sure you highlight them. All the numbers, all the percentages, you should highlight, please. Okay. Clear, everyone? All right. Now, the constant company has an annual credit sales of 45 million. Experience indicates that approximately 2% of credit sales become bad debt each year. Okay. The most recent financial statements of the company show a trade receivable of 7.5 million. Done. Constant company is considering introducing an early settlement discount of 1.25% in exchange for payment within 30 days. It believes that approximately 70% of the credit customers would take the discount, while remaining 30% of the customers would continue to pay as at present. So whatever days they take it right now, they will take the same days. Bad debts would expected to fall by, the word is by, this amount. Okay. Now, instead of introducing early settlement discount, company would accept an offer if offer it has received from the factor. If the offer is accepted, the factor would take over managing the trade receivables of the company in exchange for an annual fee of 1.5% of the sales. They will take over and would advance, this is advanced service also that you have opted for, advance 80% of their value of receivables at an interest cost of 5%. The factor has indicated that it will reduce the average trade receivable days to 40. Very nice. And reduce bad debts to 0.5% of credit sales. Very nice. Annual credit sales are not expected to be affected to any change in receivables management policy. Company has short-term finance cost of 4% per year, and there are 360 days in the year. This is crucial, okay? Otherwise, we take 365. All right, everyone. So far, everything is going good. Please share your feedbacks. Yes or no? Okay, done. So now let's begin with the solution. Okay, guys. Part A. Now we have to financial effect. We have to work out the financial effect of early settlement discount. So the format is very important. Early settlement discount. Okay. First, benefits. Okay. What benefit you think the company will enjoy if they give the discount? Come on, everyone. So the benefit that the company will enjoy first is of bad debt. Bad debt will fall by 225,000. This is a genuine saving. Okay. By how much amount? I can do calculations in thousands, okay? So 225,000. Here it is. Other benefit. Working one. Okay. Let's make working area here. Now, guys, decrease in finance cost. Yes. Okay. Yes. How will I work out? 70% of the customers will go with the discount offer. Whereas 30% will not change their behavior. So I want to now know that those who will pay early, will they pay in 30 days? Yes, clear. Those who are not changing, how many days they take generally? So let's work out that. Current receivable days. Okay. How to calculate it? Guys, come on. You have the formula. Current receivables 7.5 million divided by 45 million is the sales into 360 days. How many days to assume? 360. 60 days is the current receivable days. So 30% will not change their behavior. Let's work out the revised days. How? Very simple. Let's work out the average. 70% will pay now within 30 days. Okay? 30 days plus 30% will pay within 60 days. So I'm calculating the average days, revise days. 70% will pay within 30 days and 30% will pay within 60 days. I had to work out the number of receivable days right now. So the revised days will be 39. With me, everyone? Yes or no? Okay. Now, current receivables 1750. Let's take 2-3 digits at least. Okay. Yeah. Current receivables. Revised receivables. How will I calculate? What is the formula? What is the formula? Same. You have the days now. From revised days, you can work out revised receivables. From revised days, you can work out revised receivable. Same receivable days formula will be applied here. Okay. So now 39 days divided by 360 multiplied by sales value. This is the sales of 45 million. Are you with me, everyone? Yes or no? Yes or no? 39 days, revised days, divide by 360 into 45,000. Okay, this is not 175, this is 7.5 million. Okay. So these are the revised days figure. Are you with me? Yes or no, everyone? Clear? All right. Decrease in receivables by how much? This minus this. 2625. 2625. Finance cost. How much is the overdraft rate right now? 4%. Okay. So decrease in finance cost. Let's work out, my friends. This multiplied by this. Excellent. Okay, everyone. Okay. So this is the saving that you are getting in finance cost. Everyone, please participate. I hope this is clear to all of you. 105. Now, any other saving you think will be in case of early settlement discount as per this scenario? No. Two savings. One is bad debt, one is the finance cost. I'll compare this with the cost. So the first is the discount cost itself. 45,000 is the sales. How many people are taking the discount? 70% will take the discount. Very nice. What is the discount percentage? The discount percentage is 1.25. Okay, 1.25%. Are we clear, everyone? 393.8 or 75. Now, what is the net cost? Net cost of discount. This minus this. So, unfortunately, there is a cost that will arise because of this discount. If I offer discount, this will result in a cost of 64. This is a bad news. Everyone, if you are ending up with a net cost of discount, should we offer discount? Say yes or no. Yes or no? No, no discount. Halas. Run away, run away. Come on. No reply. No discount. Yes. Forget it. Get lost. Okay. Done. Next. Next. What is the next one? Factors proposal. Factors proposal. Now, in factor again, benefit of factoring versus the cost. What benefits will you enjoy because of factor, everyone? Are you with me? Wake up, wake up, wake up. The factor benefits include the bad debts will reduce to 0.5 of credit sales. Bad debt reduction will be the first benefit. Okay? As per the question. So, first benefit is the reduction in the bad debt. Please look at the word. The word is reduce bad debt to 0.5% of credit sales. Okay? Now, this means what? This means how we'll work out the bad debt? Decrease in bad debts, because if you opt for a factor, so this will reduce the bad debt to 0.5% of credit sales. Okay? Right now, the bad debt are 2% of credit sales. So from 2% of credit sales, it will come to 0.5% of credit sales, which means how much is the reduction of bad debt? How much is the reduction of bad debt? Come on, guys, can you please tell me? It's 1.5%. Very nice. 1.5%. Very nice. Beautiful. Lovely. Lovely. Okay. So it's 45,000 multiplied by, currently the bad debt are 0.02. Now it will come to 0.005. So the difference is 1.5%. So the bad debt reduction will be by 1.5%, which is 0.15. 0.15. Are you with me, everyone? I hope no problems as far as this is concerned. So let's work out the figure. The figure is 675. 675. The current bad debts are 2%. Now it will come to 0.5%. So there will be a saving of 1.5% of bad debt because of factor. Because of factor. Okay? Clear? Done. What else? Decrease in finance cost. Decrease in finance cost. Okay. Why? Let's work out. Let's look at the working area. Current receivables, revised receivables, decrease in receivables, finance cost. Let's copy this entire format and paste here. Okay. Very nice. Now, current receivables, same 7,500. They are saying the factor will bring the receivable days to 40. So I'll work out here. Everything will be the same. 40 days divide by 360 into 45,000. That's the beauty of using spreadsheet. Saves massive amount of time. I will just change the days, will make it 40 days. So everything is done. Everything is done. Lovely. Nothing done automatically. Formula were there, everything was there. I just copy pasted and changed the figures. That is what I say, use spreadsheet to your advantage. It will save your time. Lovely, Mania, lovely, lovely, excellent. Reduction in the receivables is by 2,500. Hence, the reduction in the finance cost is by 100. Awesome, beautiful, excellent. Wow, wow, wow. I think that's done for the cost side. Sorry, the benefit side. Let's sum up these two. This versus the cost of factor, which includes factor, Mr. Factor fee, and additional interest cost on factor finance. Factor fee, come on, tell me guys, what is factor fee? Yes, please. Okay. Everyone, 45,000. What is the fee factor is charging? Mr. Factor, you are charging a fees of 1.5% of credit sales. Yeah. Done. Done, 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 done. Right? Done. Perfect. Additional interest cost on factor finance. Now then your receivables are 2,500. After the factor, the receivables is 2,500. So 80% of this will be advanced by the factor. 80% of this will be advanced by the factor. Alas. This is the, sorry, revised receivables. This 5,000, 5,000, 5,000. See? Yeah. This amount multiplied by additional 80% of this amount will be financed by the factor. The factor is charging how much interest cost? 5%. The factor is charging 5%. What is the OD rate right now? 4%. 4 and 5. What is the additional cost you are paying? 1%. If you take finance from the factor, additional cost is 1%. 1%. 0.05 minus, just showing you the calculation for your ease, okay? Alas. So the revised receivable 80% will be financed by the factor multiplied with the additional interest cost and factor finance. 40. Awesome, lovely, excellent. My friends, let's work out the net cost and benefit. I see here net benefit 775 minus 715, 60. Clapping for myself. 60 is the net benefit. Done. Any problem? Clear? I hope everything is very much clear to all of you. Those who are still confused about the bad debt reduction, so let me tell them, they might be wondering why not 2% if someone is. So this is a this is a recourse factoring. Okay, this seems to be a recourse factoring. Nothing is mentioned that factor will take up the responsibility of the bad debts. They will reduce the bad debts. Now, this is a genuine reduction in the bad debts. In recourse factoring, you have a genuine reduction of the bad debt, which means because of the brand value of the factor, their name, their reputation, people with weaker hearts, they make the payment. People with weaker heart make the payment. This is a genuine reduction in bad debt because of the factor's reputation, the fear. Okay. If the question would have mentioned that factor will take up entire bad debts, then exact 2% would be the saving here. So right now it's the genuine reduction in bad debt that we have taken here. I hope this is clear to all of you. Now the third requirement, advise which proposal financially preferable. The first proposal was giving you a cost. The second is giving you a benefit. I have no doubt about this. The factors offer is financially viable for which company? What is the name? Constant Co. For CCO, as it results in net benefit compared to net cost. Offered by early settlement discount. Awesome, lovely, beautiful, excellent, perfect. Okay. Okay, everyone. Clear? Okay. I can still see people are asking me question, why 2%? Where is 2%? What is decrease in bad debt? My friends, there are two services. One is recourse, one is non-recourse. Okay. Here I took the difference of 2 and 0.5. Why? Because the question mentioned the factor will reduce the bad debt to 0.5% of credit sales, which means bad debts will go down. This seems to be a recourse factoring, where factor is not taking the responsibility of the entire bad debt. Had this been mentioned here that they are taking the responsibility, I would have written here complete 2% saving. Because the question gave me a hint by mentioning that they will reduce it to this much percent, this makes it clear that factor will reduce the bad debt genuinely, not taking up the responsibility. As I said, people with weaker hearts will pay, who previously were not paying the company. All right? Clear? Done? Yes. What is the question, Mohsin? Tell me. Say something, Mohsin. What is the question? Okay. I hope this is clear to all of you. 2% is also given in the question, okay? In settlement discount, the discount is 1.25 discount. I Mohsen, I think you are not clear what you are saying. That settlement discount is 1.25%. Okay. So we can, yeah, we can do like this. We need to work out the discount value. So I don't need to work out the sales value after discount. So I will multiply this with 1.25 to get the value of discount. I need value of discount, not the value of sales after discount. Okay. All right then. I hope this is clear to all of you. This will give you 1 mark. The comment will give you 1 easy number. 4 marks for settlement, 5 marks for factor, 1 mark for comment. Easy, simple, 10 marks in your pocket. There are easy numbers available in the exam. Please grab those. Okay. Now, 3 benefits of centralized treasury management. Centralized treasury management, which means there is a centralized system and all the department treasury will be handled at a center location and there will be no decentralization of it. Okay. So there will be so many departments there. Treasury will be managed together and this will result in lot of benefits. Lot of benefits. First of all, bulk investment of surplus cash relating to all the areas will be done together resulting in better short-term rates hence this will improve business profits. Okay, so everyone cash will be at one place, collective investments can be done, better rates you can negotiate with the bank. Similarly, the vice versa of this, the combined borrowing requirements will be clear in front of Treasury Department so they can ensure bulk borrowing can be done resulting in better rates to be negotiated with the banks. This also will help to get better terms and improve business profits. Bulk borrowing. Yes, guys. Yeah, bulk borrowing. Okay. Third, very important, better foreign currency risk management can be done by the centralized treasury department. Okay, as they can net off foreign currency risk exposures. Okay, facilitate external and internal foreign currency hedging. Okay, and better overall risk management planning can be done. Wow. So many other benefits like duplication of work will not be there. Okay. Better skill set will be pooled together. And better monitoring of funds can be done. So many other things that you can write. So I think we are just required to write 3, and they have given us the boxes here. Very nice. It looks more good, systematic. And I think that's pretty much clear to all of you without any doubts. What do you think? Yes or no, everyone? Clear? Happy? Very nice. Next requirement. Should we move? Yes. Discuss. What to discuss? 2 cash management models used in financial management. 2 cash management models. Guys, which models are what that you can write here that you have covered? So, very simple. Can you name them? Can you name them? First, Bimal model. Second, Miller Orr model. First model. Okay, what is this one? You have to discuss the two cash management models, okay? Which means what will they do? What is their result? What challenges you face from them for 2 marks. This model helps to calculate the amount of cash required to calculate the optimum amount of cash required to transfer between accounts, for example, from investment account to current account for daily cash for cash for daily cash needs. Okay, done. Okay, the model is similar to EOQ model of inventory and assumes that demand for cash remains constant along with along with along with along with holding cost, transaction cost. Okay, transaction cost to be constant as well. Is that right, everyone? Yes or no? Okay. However, in practical world, this might not be the case. Okay. And more importantly, the demand for cash will vary. So the problem of BIMALS is that it is not dealing with the demand for cash variation, and that is why there was a need to go towards Miller-Orr model. All right, everyone, come on. This is all knowledge-based stuff, yaar. You can write all this crap. I think it's not difficult at all. No linking with the scenario. It's an application-based question. No, it's a knowledge-based question. Verb, object, marks, application-based, knowledge-based. This is a knowledge-based question, yeah. 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100% 100 Easy. Come on, easy. Mirror old model. This model deals with demand, deals with fluctuation in demand for cash, as it believes that cash requirement will change. Okay? Clear, everyone? So the model uses certain limits, certain levels, like upper limit if cash reaches here, buy securities, and lower limit, buy securities to come back to lower limit, return point, return point. And lower limit if cash reaches here, so sell the securities to come back to return point. Okay? Done? Clear? So, model calculates spread difference between upper limit and lower limit that indicates the cash fluctuation. Right? Clear? Yes or no? Model does uses variables like variance of cash flows, transaction cost, and interest and daily interest rates. Daily interest rate for above calculation and is considered more better than Bimmel's model due to practical consideration of changing cash demand. Khalas. Khalas. Clear, everyone? The positives and the negatives I've written here. Done. 20 marks completed. I hope this is clear to all of you. To deal with theoretical area, the rule is what? Tell me. The rule is what? Look at the verbs, the objects. Is it knowledge based or application based question? And headings, if you can plan according to the objects. Done. So I hope this entire question of working capital management is super clear to all of you. All right, everyone. Understood? Happy? What's your feedback? Easy? Emoji based feedbacks I need. Everybody wants to know the feelings of each other these days. So feeling based feedback. All right. Hearts, laughs, cheers, thumbs up, thumbs down. It's time to take a small break. And after the break, we'll be targeting next area of risk management. See you after the break. So welcome back, everyone, and let's start with risk management revision. Risk management includes two important areas. One is the currency risk and second is interest rate risk. Students do struggle in this area. I don't know why, but this is one area you need to look at. Let's begin. First of all, the first is to deal with the currency risk, foreign exchange currency risk. Now, any business or businesses that deals with imports and exports, okay, businesses that are dealing with imports and exports, they are suffering from this currency risk. Now, currency risk arises when you are selling into a foreign market, you're buying from the foreign market. Maybe if you are selling in the foreign market, so what you get in return is the foreign receipts. And those receipts, when you get into your local currency, the value may go down due to adverse fluctuation in currency rates. So that is a currency risk for that exporter. Similarly, for an importer who imports the products from different countries, so when they are importing, the cost of import going up is another risk that they are facing, and this is known as importers' foreign currency risk. So what exactly can be done to deal with these foreign currency risks? So first, you need to understand of how many types these foreign currency risks do exist. So the first is known as transaction risk. Okay, first is known as transaction risk, and second is known as economic risk, and third is known as translation risk. So first of all, if I start with the transaction risk here, okay, first of all, if I start with the transaction risk, so what is a transaction risk? On every transaction of your foreign receipts or on every transaction of your foreign payments, the adverse movement in exchange rate either affects your receipt value or increases your cost of imports. This is transaction risk. On every transaction, if you are facing this risk, this is known as transaction risk. The longer term version of transaction risk, is known as economic risk. Economic risk. Longer term version of transaction risk is known as economic risk. This means if on a regular basis you start suffering from such exchange rate fluctuation, like you are a business who basically imports the foreign cars, okay, and over a 2-year period there has been a constant devaluation of the currency, your currency I'm talking about, the country in which you live. So what it results in, what it results in, it results in it results in it it results in a situation which means that uh, your cost of imports are going up again and again. Your cost of imports are going again and again, and when your cost of imports are going again and again, so your foreign cars are becoming expensive than the local cars. Now, if you look at a longer term impact of this, that foreign vehicles are expensive in the local market and the local vehicles are getting cheaper in the local market. So overall, it affects the business. People start to move towards the local cars. They leave the foreign cars. So the demand for foreign cars goes down. And when the demand for foreign cars goes down, this means your sales gets affected, your business profits gets affected, your shareholders wealth will be affected. Shareholder wealth will be affected, and this is known as economic risk. Economic risk, longer term version of transaction risk. If on every transaction you are facing this risk, is a transaction risk, but over a long period of time that is the case, it affects the business cash flows in long run. So this is economic risk. Then comes translation risk. What is a translation risk? Translation risk is a risk which is an accounting risk. It's a bookkeeping risk. It's not a cash risk. It's an accounting risk. A company has made an investment in the other country. A parent has made an investment in the subsidiary. So at year end, the parent will revalue its investment done in the subsidiary in other country currency. That revaluation at 31st December will or might result in an unrealized gain, unrealized loss. That unrealized loss is a translation risk. It's not a cash-based risk, okay? So this is an accounting risk. Now, how to hedge transaction risk? How to hedge transaction risk? How to hedge a transaction risk? So simple, my friends. There are different techniques to deal with transaction risk. First, forward contracts, money market hedging. Forward contracts, you lock into a rate in 3 months' time, 4 months' time, whatever the rate will be, it is not your tension. Your rate has been locked and the transaction will be done at that rate. Forward contracts. It's a binding contract. You are locked into this contract. You cannot run away from this contract because this is a rate that has been locked in the future. Halas. Money market hedging. Money market hedging ensures that the conversion into the currency is not made after 3 months or after 6 months when you will receive the currency or you will make the actual payment. Money market hedging ensures that the transaction of conversion is done today only. Yes, today only, not tomorrow, not after 3 months. So this is a model, or this is a technique in which you convert it now by borrowing and lending. And you guys know, those who are with me from day one, they know that what is the problem that they are having is they are facing a problem in which, they know there are two situations: borrowing, payments and receipts, and the mnemonics are what? BCD, DCB, BCD, DCB. Okay, so this is money market hedging. After that, after that, the next technique, after that is derivatives, like options, currency options, like currency futures, like currency swaps. These are the options that are also good for the hedging purpose. Are you with me? The internal ways to manage such a risk includes netting, matching. What is matching? In future, at a same date, if you want to pay in a foreign currency and if you expect a receipt from that foreign currency in 3 months time, $100 payment, $200 receipt, you can match them, you can match them, you can match them, and what? And what? The difference is what you will hedge then. Netting can be done easily by subsidiaries, parent company, intra-company, receivable and payables to be adjusted. Then leading and lagging. What is leading? Before the actual time period of payment, you are settling your liabilities. For example, if you feel like in 3 months' time, the rate would become more adverse. Exchange rate I'm talking about. So let's do the transaction now, today. That's it. Khalas. Leading, lagging, settling your obligations after the due period. Maintaining foreign currency bank accounts. What are foreign currency bank accounts? Foreign currency bank accounts simply means that automatically you will be hedged. How you will be hedged? Very simple. Your foreign payments will be done from that account. Your foreign receipts will come in that account. Khalas, hedging done. So these are the internal ways to manage it. So these are the ways to handle transaction risk. My friends, why does a currency fluctuate? Why does a currency fluctuate? A currency fluctuates due to demand and supply. Due to demand and supply, which means what? Export-import imbalance. Export-import imbalance, which means that if there are too many imports done in a country, so foreign currency will go out. Less exports, which means less foreign currency will come, resulting in a devaluation of your currency. So balance of payment imbalance results in currency fluctuation. Okay. Now, certain theories, interest rate parity theory, an interest rate predictor, a forward rate predictor. Through the interest rate differential, you predict forward rate. Purchase power parity theory. through the inflation rate difference will predict future spot rate. Fisher effect says the real rate remains the same. It is the inflation difference that results in nominal interest rates. International Fisher effect says the differential of interest rates, okay, the differential of interest rates will result in a difference in it is the interest rate differentials or nominal interest rate differential that results in the fluctuation of the currency rates. Okay. Expectation theory says at a certain time, both forward rate and future spot rate will become same. So this is well covered by four-way equivalence theory. Remember, according to interest rate parity theory, country with higher rate of interest will be subject to higher depreciation of its currency. According to purchase power parity theory, country with higher inflation rate will be subject to higher depreciation of its currency. Okay. Now, the other risk a business is facing is known as interest rate risk. Interest rate risk. If you want to borrow in future, the interest rate might go up is a risk for the business. If you want to lend in future, the declining variable rate, floating rate is a problem for you. So how to hedge yourself? Techniques like FRA works for you, forward rate agreements, where you do a binding FRA contract, you lock a rate for yourself, no matter what is the rate in the future, your dealing of borrowing or lending will be done on the basis of FRA, forward rate agreements. Then matching technique says you can match your assets, like you can match your fixed assets with your fixed liability. A bank can do it. Now, bank will lend, bank will borrow. Bank, when lends to someone, is an asset for the bank. Bank when will borrow will be a liability for the bank. So what bank can do? Bank can match its fixed rates lending with its fixed rates borrowing. Okay, and same goes for floating as well. Then comes smoothing, keeping a balance of floating and fixed rates. Okay, these are the techniques that helps you to handle these sort of risks. But remember that there are other techniques like derivatives will work here as well, like interest rate options, interest rate futures, and the interest rate swaps can help you to further manage the risk of interest rates. But again, remember, there is always a basis risk involved, which means your hedging might not be perfect, your hedging might not be complete, your hedging might not be perfect. Any imperfect hedging is due to basis risk, which means that hedging will not be perfect, you will not completely be hedged due to the impact of basis risk, which means the change in the derivative might not be exactly same as the change in the actual market, right? The other risk is gap interest rate risk, the risk which says that there will be difference between the amount of asset and liabilities, like any company, maybe a bank, having more assets means lending, then more liability means borrowing, will be in an asset sensitive position. A bank having more liabilities mean borrowing, then the assets means lending will be in a liability sensitive position, followed by a case where bank has an equal amount of lending and borrowing, means a balanced gap position. Now, the yield curves are a very key indicators of the economic condition. A normal yield curve is a sign of economic boom. When short-term rates are lower compared to long-term rates, followed by inverted yield curve where short-term rates are higher compared to long-term interest rates. It's a sign of economic recession in the economy. With flat yield curve indicating transition as short and long-term rates both are equal, a transition from economic recession towards boom or from boom towards recession. Okay, so these are good predictor of economy. Now, how these yield curve finally result in which shape? So three theories acting together results in such yield curve, starting from liquidity preference theory, which says that it is the liquidity that results in the decision about what the return will be. So for a longer period of time, if someone will invest, will expect a higher return. Followed by expectation theory says it is the expectation that results in the rates. Like if you feel like there will be more demand, there will be more increase in the long-term rates, so the long-term rates will go up. Similarly, market segmentation theory believes that markets are segmented between short and long term. People preferring short term will go towards short term and vice versa long term. Once the shape of the yield curve is determined, finance managers, companies can take massive benefit by understanding where the economy is heading towards. It will help them in managing their interests and loan decisions. Like if you think in future it's an inverted yield curve, so remember long term variable borrowing will be beneficial for you because it is clear that the long-term rates would be lower due to inverted yield curve, as we can see here. So any variable, any borrowing done in the long term, any borrowing done in the long term will be useful because of the lower rates, right? So yeah, this is how it helps. I hope this is clear. It's now time to move towards the section B question. Certain tip says actively read the scenario as 5 questions are connected to that. Make sure rounding off instructions are well read by you people. Try to complete within 18 minutes. To do that, it is important to ensure that you start first with your easy MTQ, the one you feel you are more confident. So solve those first because it will take less time and will ensure that you complete that within the time frame. Even it will help you to save the time as well. Okay. Lastly, the one that you selected initially, the one that you selected initially in that MTQ, solve the easy OTs first. 2 easy OTs first because those easy will give you more marks. In fact, 4 marks easily. Then you are just left with 1 more to go because once 6 marks are done in one MTQ, you will ensure a just pass. And once just pass is in your pocket, you are safe in that question. So target the easy 2 to 3 questions first to grab 6 marks out of 10, hence 18 out of 30. Let's begin with the question. All right, guys. So here we are with MTQ question. Let's handle it. Let's see how one can handle this in easiest way, how we can target the easy questions and all. Let's start. A large manufacturing company, TCO, imports its raw material from foreign country and sell its product in its home country only. Okay. Imports understand the scenario. Raw material from foreign country. So they are into buying the raw material from foreign country and sell its product in its home country. So any adverse movement in exchange rate for them would make their imports expensive. And once import gets expensive, the cost will go up. It may result in cheaper local products over the imported products. To pay for its raw material purchases, the company generates, okay, suitable debt financing in foreign countries. So to pay the raw material, what they do, they take foreign currency loan. Okay. The home currency is dollar. Do highlight it because it's very important. While foreign currency is euro. A forward rate agreement means FRA has been used on the borrowing for recent raw material of $10 million. Okay. Okay. It's a FRA. It's an interest rate. Okay. Before the purchase, a 3v6 FRA showing the rates of 4 and 3.6 was acquired in the foreign country. Okay. So what they did, because they take foreign currency loans, so they went for a 10 million FRA in foreign currency with 3v6 FRA offered to them, rates 4 and 3.6. The actual base rate applicable on the borrowing was 3.2. Okay. Separately, T company will receive a volume discount of euro 1.5 in 3 months' time to protect against a depreciation of the dollar. The finance director has decided to set up money market hedge for this amount. Okay. Done. Done. The spot trade is given to you, so it includes both foreign currency and interest rates. You can see the interest rates. The first question is here. Let's solve the first one. The finance director is analyzing the yield curve in foreign countries market to select a suitable financing strategy. So the yield curve of foreign country is available. He observes that yield curve has recently changed from normal yield curve to become an inverted yield curve. So the foreign country yield curve indicates that it is shifting from normal to inverted, means the short-term rates will be higher while the long-term rates will be lower. Okay. Which target two of the following are true in this situation? My friends, I always say this as a rule of smart paper solving technique, always try to filter out the ones that can never be the answer. So read all the statements and figure out the one that can never be the answer, that are very obvious statements, out of the box statements. Discard them so that you get close to the answers. Let's begin. Bonds with a long-term maturity term will have higher returns. Okay, just understand, convert this statement or a sentence into your local language so you understand. It says the long-term bonds will have higher returns. Is it true? If it's an inverted yield curve, so according to inverted yield curve, and if you look at the yield curve itself, it is like this, which means 5 years rate will be less compared to 2 years rate will be more. Okay, this is the interest rate. So 5 years rate are lower in inverted yield curve. So this statement is totally wrong because it says long term maturity bonds will have a higher yield. No, wrong. It's an inverted yield curve where you can see 5 year rates are lower. Out of the box, throw it out. Second, tea company is exposed to rising interest rates in foreign country. Tea company is exports. Tea company is export. Tea company is exposed to rising interest rates in the foreign country. No, because the inverted yield curve indicates that interest rates would go down, not increase. Okay, so it's not the right thing. It is not exposed to rising interest rates in foreign country. Reason being, it's an inverted yield curve. Okay, the more in future you get into, the lower will be the rates. Wrong. Now, because these two are out of the box, a good reading will make it clear that these are not the answer. To be honest, the next two will be the answers because two statements are correct. You will not bother much about it, and for sure these will be the answers. Even if you don't read it, these are the answers. But for your ease, I'll read it. The change would have been beneficial for T if it had issued long-term variable rate debt before the inversion. Okay. Now, if they would have taken a long-term variable loan before the inversion, right? So this would have been a better option for them. Now, when it was a normal yield curve, transition from normal to inverted yield curve, they are saying that when it was a normal yield curve or maybe in a transition phase, if you would have taken a variable loan at that time, okay, so it would have been a benefit for them because yes, the longer term rates will go down. So because it is a variable long term debt, so in future the rates would go down. It's a variable, so the rates would go down. Whatever the floating rate is, that they will take benefit from. Yes, this is correct that before inversion, if they would have opted for it, so it would be a beneficial thing for them. Yeah. Second, raising euro bond. Euro bond is issuing foreign currency bonds. Foreign currency bonds, okay? Raising euro bonds in foreign countries' currency has become more attractive. Yes, in foreign currency, it's an inverted yield curve. So raising euro bonds would have been will be attractive for sure because you are issuing bonds in foreign currency, and foreign currency is suffering from inverted yield curve, which means long term borrowing is useful because the rates are low. Yes. So statement C, statement D, both are in support of inverted yield curve. So the tip is read it, convert into your local language, and filter out the wrong ones. You will get close to the right ones automatically. Simple. Next, which of the following best describes basis risk? Basis risk. Read all the statements and see which are not the answers. Just filter them out. Number one, interest rates changing before bonds are issued. No, this is not basis risk. No. Foreign currency becoming more expensive to buy. No. This is a normal risk, transaction risk that you face. No. more funds needing to be raised due to increase in raw material cost. All the three are so clear to a reasonable normal student that fourth, if you even don't read, will be the answer for you. The funds needed at maturity not being entirely hedged. Yes, imperfect hedging. Imperfect hedging is basis risk. Imperfect hedging. Okay? Clear. Well, I hope no problems. Yes? Which of the following is the correct transfer in relation to FRA? Correct transfer in relation to FRA. Okay? Now, it's a forward rate agreement they are talking about, and you need to understand that how FRA works. So, the way FRA works is you deal with the bank in the normal way based on the actual interest rate in the market, the time of borrowing or lending. You use that actual rate first. If that is a higher rate compared to FRA, you use it. If that is a lower rate compared to FRA, use it. Then you compare that actual rate with FRA and see and calculate the difference. Okay, the difference. If the rate is more, then also a difference. If the rate is less, then also a difference. If the rate is more, you pay the bank in case of borrowing the additional amount. If the rate is less, the bank pays you back. I mean to say that if the actual rate is less than the FRA, okay, so the bank pays you back. If the actual rate is more than the FRA, then the bank pays you back. If the actual rate is less than the FRA, then you pay the bank the differential amount. Okay, and this is how you work out the net cost. So here it says they want you to work out the transfer, correct transfer to be made. Let's have a look here. Let's highlight 10 million is the amount of loan which you are expected to take in 3 months time, because it is 3v6, and from today you need to hedge yourself for 6 months. So it's a 3v6 FRA, and it is a borrowing case, so higher will be the borrowing rate, which is 4. Okay, at the time of borrowing the actual rate was 3.2. Okay, now the transfer they are talking about, which means the differential they are talking about. So the FRA, the locked rate was 4%. The actual time borrowing rate was 3.2. So you paid 3.2, but the FRA is 4 on the amount of 10 million. That you have to prorate, because this is 3v6, means in 3 months time you need for next 3 months. So 3 months hedging is required to be done, and the rates given to you by default, if nothing mentioned, are assumed to be the annual rates. So you need to prorate it by default, multiply by 3 divided by 12. This was the biggest mistake students did, that they didn't prorate it. So if you work out the difference using 10 million and prorating it for 3 months, the amount will be euro 20,000. Okay, 20,000. Now this 20,000 amount is a payable amount Obviously, because you have to pay the bank, because the rate that was locked is 4, you paid it 3.2. This is the locked rate. So the additional that you have to pay is 0.8%. I hope pretty much clear to all of you. Alas. Done? Done, 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 done. Perfect, everyone? Say yes or no. That's it. Next. How much will T company expect to receive from Euro 1.5 million volume discount? Euro 1.5 million euro discount. This means you are getting a discount of 1.5 million in 3 months' time. Okay? Let me go back to the previous question. 10 million is the loan amount, right? So on this 10 million, the differential will be applied, and this differential will be 0.8%. If you see the working here, 4 minus 3.2, 0.8. They are asking the amount to be transferred, which means how much additional will you pay to the bank. Okay? So you work out 0.8% into 10 million into 3 over 12, because that's the annual rate. So you will get this figure for sure. Okay? The word transfer makes it clear that this is the additional that you have to pay to the bank because of FRA, because your rate has been locked at 4. Understood? Okay. Now, how much will the company expect to receive from 1.5 million volume discount? Now, first of all, this 1.5 million volume discount is what? A benefit for the company or a cost? First, decide this. It's a benefit. It's a discount in euros. So, obviously, this will be considered as a receipt or a payment. So, obviously, it's a receipt case for T company. Okay? 1.5 million discount. Now, if it is a receipt case, so what will we apply here? The shortcut that I told you, BCD. BCD is so easy to remember, BCD. Borrow foreign currency now. The amount of discount is 1.5 million euros. Okay, so let's work out the present value of this. 1 divided by foreign currency borrowing rate. Euro borrowing rate is 6%. And this we are expecting in 3 months' time. So for 3 months you have to borrow. Okay, for 3 months you have to borrow. Is it clear to all of you? So 6% multiplied by 3 over 12. So what is the figure will you get from this calculation of euros in present value? Is 1477833. Okay, 833. Done. Now we'll convert this into spot. Now, that's the beauty of money market hedging. At spot rate, so the rate is 1.16, and I have to divide this for sure. Those who are still concerned, why? Because it's a foreign receipt, first of all, plus foreign currency is euro, local currency is dollar, and if you look at the spot rate, it is given to you euro per dollar. So dollar is in denominator, and when it is in denominator, we this is an indirect quote, and when it is an indirect quote, the rule that I've taught you, the easy ones like bus and divide. So here you have just one rate, so no issue for the selection of the rate, but divide is what you will be doing here. Once you will divide, you will get the answer of dollar, which is 1,273,994. Now, BCD, deposit dollars now for 3 months. So 1,273,994 into local currency deposit rate is 2%. But this is annual rate again. And what exactly you are required to work out? Okay, the total amount. So we will multiply this, obviously, by 1.02 multiplied by 3/12 to prorate it. So the amount after the interest that we'll receive is 1,280,364, which is the amount that we'll receive from this money market hedging. I hope it's a very simple case of BCD and no problem at all. It won't trouble you at all for sure. All right, everyone? Yes or no? Okay. So 1,280,364 is the answer. I hope we do get this option. Here it is, 1,280,364. Right. Done? Clear? Nice. Next, the finance director believes that in current market conditions of the foreign country, using an interest rate option, okay, current market conditions of foreign country. So what exactly is the current market condition of foreign country? Tell me. The current market condition of foreign country is inverted yield curve. Right? Yeah. The country is moving from boom towards recession. Okay? So now what is better? Let's see. Using interest rate options could bring additional financial benefits. Just a minute, please. Okay, the first question mentioned this. Okay. This was the assumption that we were taking before the start of this question only. Okay, that is where we had to look at the yield curves. Okay, fine. Got it. I was finding here, but it is not here. It's related to the first question. Okay, anyways. So the question is, the fund director believes that current market conditions of foreign country using interest rate option would bring additional financial benefits. So they have already decided that the interest rate options will be beneficial for them considering the current market condition in the foreign country. Which two of the following, which two of the following are true about an over-the-counter interest rate options? Over-the-counter interest rate options. First of all, you should know the term interest rate options. It's not a binding agreement. It will not bind you. It's not an obligation. If you feel like the exercise price of the option is favorable for you, then you use it. Otherwise, you allow it to lapse. Okay. Over the counter means it's tailor made. It is not traded. It is not an exchange traded option. So it's a tailor made over the counter. Now, first, it can be traded on financial exchange. Okay. Number two, it is an agreement with a financial institution. Okay. It requires payment of an initial premium. Okay. It must be exercised at its maturity date. Okay. Things which are very simple and to figure out, let's lock them first. And you can decide one by one. Is it compulsory to be exercised? No. It's not an obligation. If you feel like it's favorable, then do it. Otherwise, allow it to lapse. So this is not an obligation. This is wrong. Throw this out. Payment of an initial premium. Yes. In option, you need to pay premium at the start. Yes. This is true. This is correct. Okay. Tick. Now, one out of the remaining two. It can be traded on financial exchange. No. Why? Because these are over the counter, tailor made. These are not exchange traded options of standard amounts, currencies. So these are over the counter. So it cannot be traded on exchange. But it is a financial agreement with a financial institution. It's an agreement with a financial institution. That is clear. Okay. But it is not traded on exchange, financial exchange. That's it. Khalas. Done. Any problem? No. Clear. Done. So this is how you have to handle the MTQs. Remember the scenario for theory-based OTs. Remember, filter out the wrong ones, get close to the correct ones. And I hope this entire question of risk management is clear to all of you. All right, there, everyone. I hope this is clear to all of you. Yes or no? Enjoyed it? Now, it's time to move towards Section A key tips. A lot has been discussed about B and C's. Now it's A. First of all, A is not scenario based. It can come from any area of the syllabus and book. So that is why cover whole syllabus. Financial management function, environment are those popular areas where you see 2-3 OTs coming from there, and any place they can come from. A basic average is 3.6 minutes per question that you have to ensure, but that is not possible because there are in total 15 OTs that you have to solve in 54 minutes. Okay. So to achieve this average, it is only possible that you first start with easy OTs. There are 5 to 6 easy OTs which will take less time and will give you a short score. If 4 are easy, so 8 marks are in your pocket for sure. Okay, 8 marks will be in your pocket for sure. Learn the techniques. Are you with me? 8 marks will be in your pocket for sure. So these will take less time, not 3.6 minutes, maybe 1 minute, 2 minutes per question. So less time, short marks. So once you are able to grab 8 marks by ensuring 4 are your correct ones, then you just need how many more? Further 8 marks to ensure you just pass in Section A questions. To ensure you grab 16 out of 30, you are able to grab 16 out of 30, you are passed in Section A. So just more 8 marks means further 4 needs to be corrected for you. 4 easy ones, the other 4 means 8 OTs altogether. So once you are taking less time on the easy ones, you can skim it, you can move on. You have a navigator tool available, so you can spend more time on difficult ones. Just imagine there are 15 out of 15, if 4 are done in no time, so you can spend all the remaining time on 11 OTs, and in those 11 OTs, just 4 needs to be corrected ones to just pass in Section A. I'm not saying your target should be to just pass, but you have to ensure minimum just passing marks in Section A. And like this, if you pass in Section A by getting just passing marks of 16 out of 30, 8 OTs, you pass in every Section B scenario-based MTQ by grabbing 6 marks. So you get 18 in Section B out of 30. So this means 16 plus 18 takes you to 34. You just need remaining 16 marks to get to 50. And those 16 you have to get from 40 marks CRQ. Even less than 50% marks. And you pass. Once you get 50, it's like 100. If you get 49, it's like you failed. It's like 0. So make your life easier. Make your life simple, easier, and you will be able to make it. Done? Plus, fill in the blanks again can create trouble. Make sure you handle them by reading clear rounding of instructions. For theory-based OTs, please make sure that you read the statements. As I always say, filter out the wrong ones. Things that can never be the answer. Please filter out the wrong ones and get close to the correct answers. Okay? Distractors. Generally what I've seen, that if there are 4 statements, so 2 statements are out of the box. 2. So you are left with next 2 only. In that, one is a distractor that is pinching you hard that I'm the answer, but it is not the answer. Works like a devil. Whereas one good, nice answer is an angel. That is where the final selection should be done. Okay? There are questions where the word is or are is written, like following are is or are true. So if it say is, so out of all the statement, one will be the correct answer. If they say are, so here there are chances that more than one will be the correct ones. Okay, so do read this carefully. Is or are following statements is or are correct. If is or are both is written, more than one. Is just one. Are more than one. Okay, right. Let's apply these techniques and solve another question. In fact, very popular questions. Why I'm saying this popular? Because these are examiner report questions that examiner have highlighted because people didn't perform good in these questions. When examiner highlights questions in examiner report, it means people didn't perform well. And I don't understand why. Let's understand, let's see how complicated these are. First, Apollo needs 10 million 9-month loan in 3 months time, okay, and buys an FRA of 3 V12 with 2 rates given. In 3 months time, the company borrows 10 million at a rate of 4.5. Okay, it's an FRA question, simple. What will be the payment or receipt under FRA? Payment or receipt under FRA clearly means the differential amount again. Again, the differential amount, it is asking you to calculate. Okay, payment or receipt. Will you pay additional amount to the bank or bank will pay you back? Done. So the FRA is for the borrowing here, and borrowing rate is higher rate, 4.6. The actual rate at the time of borrowing was 4.5, which means you paid 4.5 to the bank, but the FRA was 4.6. Okay, so you have to pay bank additional 0.1%. You have to pay payment. You have to pay bank additional 0.1% on an amount of 10 million that you took. Okay, for how many months? So 3V12 clearly means 9-month borrowing. 9 months borrowing you have done. 9 months borrowing. So if you prorate this 9/10. Now this is the biggest mistake again and again and again people are doing, is that they ignore to prorate it. They forget to prorate it. So it's a payment because you paid at 4.5, but your FRA was 4.6. You have to make additional payment on an amount of 10 million prorated over 9 months. And the answer is 7,500 payment. Halas. What is the mistake? What was the mistake? The mistake was prorate. People ignored it. Halas. Is it easy? Why are you losing marks? This is not difficult. Okay? So if you don't prorate it, you end up doing it wrong. Right? Two mistakes one can do. One, forget prorate. Two, consider this as a receipt other than a payment. So the concept should be clear. The borrowing will be done on the actual rate. Then the FRA that you took will then be used and the differential will be adjusted. So you have to pay the bank. Done? Great. Next. Which two of the following are likely to occur in a country, that experiences relatively low inflation. Now this question is testing the students' knowledge in relation to how inflation affects a country. A country where inflation is low. So what will be the likely things that will happen there? Okay. Number one, I think one statement is missing here it's a mistake of typing, and that is WACC will fall. Weighted average cost of capital will fall. Okay, so this is missing here. Now, first, decrease of profitable investments. Is this correct? This is wrong. Why? I'll tell you at a later stage. Next, the domestic currency will devalue. See, when low inflation is in a country, which means the production cost in that country will be less, because low inflation, low raw materials and all. If low raw material cost, so production will be cheaper. If production will be cheaper, it will be easier to sell in foreign markets, because cheaper products if you make, like China does it what? China makes cheaper products, and that's why China exports a lot to the rest of the world except for USA. So what I'm saying is, if you are making a cheaper product, you can sell it in the foreign market, your exports will go up, and once your exports go up, more foreign currency will travel in your country. More foreign currency will come into your country, which means more foreign currency, and hence your currency will appreciate, not devalue. It will appreciate. So the local currency, the domestic currency will appreciate, not depreciate. So this is wrong. Okay, this is wrong. Now, third, domestic demand for goods and services will rise. Yes. Cheaper products, people will buy. People will buy. People will spend. People expenditure will increase. Okay. So yeah, that's correct. WACC will fall. WACC will fall. Now, why WACC will fall? Obviously, if lower inflation, which means lower will be the finance cost, lower will be the cost of debt, okay, lower will be the cost of equity, right? So if lower is your finance cost, interest rates, the lower the interest rates, the lower will be the WACC, the lower will be the cost of finance. Yes, so WACC will fall. Understood? Clear? Guys, are you with me? Yes or no? Okay, now, once the cost of finance or WACC is lower, so any investment opportunity that you are looking at, so you will discount that to calculate their NPV. To calculate the NPV, you will discount that using a lower cost of capital, WACC. So lower cost of capital means higher NPV, and higher NPV means profitable investment opportunities. For companies, investment would be more profitable due to higher NPVs. Due to higher NPVs. Yeah. Decrease of profitable investment opportunity? No. Increase of profitable investment opportunities. Because the lower the cost of capital, the higher will the NPV, and it will rise the investment opportunities. Done? Clear? Yes or no, everyone? Yes. So it will increase the attractiveness of investments, and people will go with more investments. Done. So I think this is clear. C and D are the two things that will result. Next question. This question is very commonly tested, but still people are facing problem. I don't know why. Why? Two companies, C and A, have following average levels of working capital. I feel English is a problem. Students are failing to understand the English language in this paper of FM. Honestly, they don't understand the meaning of the statement and they falter it. Average levels of working capital. Okay. Maximum working capital level of C is 20 million. Minimum is 15. Now, what is minimum? Have you heard about fluctuating current assets and permanent current assets? Yes. So, this minimum is what? Permanent current assets. And what is maximum? When you add fluctuating current asset into permanent, you get maximum current asset. If you add, so you get this figure. So, minimum is permanent current assets. For A, it's 18 and the maximum is 24, which means on top of 18, the fluctuating they require is 24. Sorry, 6. Now, if I calculate the difference, fluctuating current asset for C will be 5 million and 6 million for A, which clearly means that a demand increase results in additional 5 million for C and for A it's 6 million. Done. Now, understand it. Working capital is financed with 17 million long-term debt for C and A 18 million long-term debt. 18 million long-term debt. The balance is finance from short-term sources of finance. What you have to figure out that what policy are they following? Working capital financing strategy. Financing. Okay. Is it aggressive? Is it conservative? Or is it matching? What is working capital financing policy? Remember, working capital financing policy aggressive says all fluctuating current assets and most of permanent current assets are financed through, tell me, short term. Okay? What match conservative says? All permanent current assets and most of the fluctuating current assets are financed through long term. What matching says? Permanent current assets are financed through long term and fluctuating current assets are financed through short term. Matching. You match permanent with long term. Now, halas. For A company, 18 is minimum means permanent current assets. If 18 million is their permanent current asset, if 18 million minimum is their permanent current asset, so they are financing this permanent current assets through long term. They are matching it. They are matching their permanent current asset of 18 million by financing it through long-term debt. Long-term debt. So which policy are they using? Matching. Because the remainder 6 million, A will finance through short term. A will finance through short term. Are you with me? Okay, A will finance through short term. Alas, concept. Next. Okay. C, permanent current asset is 15 million. Okay. And their long-term finance is 17, which means 17 million is their long-term finance, which they are using first for permanent current assets of 15 million plus 2 million additional they are financing fluctuating current asset using this. Fluctuating current asset as well. So their fluctuating is 5 million. Out of this 5 million, 2 million they are financing using per long term, because the long term amount is 17 million and the requirement of permanent is 15 million. So if your permanent current asset is 15 million, but you are using your long term source of finance amounting to 17 million, this means this 17 includes 15 million of permanent and 2 million further they are financing the fluctuating current asset. This means which policy are they following? Conservative, where all of the permanent 15 million and most of the fluctuating 2 million is financed using long term 17 million. 17 million. So the policy of C is conservative and A is matching. Logical. For this question to solve, you must understand one thing. For this question to be able to solve, you must understand one thing. Tell me what? Tell me what? What? That this minimum is permanent current asset. And in this, when you add fluctuating, becomes maximum working capital. Understood? So question like these can create trouble for you people. But if you read it, understand it, you are able to make it. So let me repeat last A company for you. The minimum working capital represents permanent current asset of A, which is 18 million. Okay. And if you see their long term, if you see their long term reliance on debt is 18 million. Just match it. This 18 and this 18. You can see they are using their long term source of finance to match their permanent current asset, which is known as minimum working capital. So when you match your long term with permanent current asset, this is known as the concept of matching. Okay, I hope this is clear. The other remaining fluctuating, they are financing through short term because it is written. The balance is financed through short term. And similar working you will do for C, where you can see very simply that for C company, the permanent current asset is 15 million, yet they are using long-term finance of 17 million. This means they are using beyond the permanent current asset. So why simple to finance 2 million of fluctuating current asset as well? So when your reliance on long-term is too much, you are using that for all your permanent and also for your fluctuating. So this is a sign of conservative funding policy, and hence for A it's matching and for C it's conservative, and that's the end of this as well. So this was a tricky question. You had to use logics. Using the logics, you would have able to do it. So I think that's clear to all of you. All right then. So we are done. Any questions, anyone? Okay. Guys, I hope you enjoyed the 2 days of webinar. Please share your feedbacks. Overall, the webinar would have been useful, yes or no? We covered tips and tricks for section A, B, C, drafting was covered, calculations were covered, OTs were covered, MTQs were covered. Overall, revision was done. Happy with these 2 days of free webinars, yes or no? Come on, emoji-based feedbacks. Come on. Happy, everyone? Great. Now, what is the next plan of action? Number one, ask your friends to watch this free session from VIFHE's YouTube channel if they haven't. This will help them to pass. Number two, you can even watch December 25 webinars for further coverage of these areas. Together, these two will give you a good coverage of FM. Self-study students can join my revision batch with top areas I'll be focusing on. We'll be telling them the top areas. They will have the practice material for that. Other than that, remain active in the group, general WhatsApp group for further updates. Thank you very much, guys. I hope you enjoyed it. I hope you pass. Best of luck. Give your best. For any help, contact me. Thanks.